Imagine it is 1994. A child is born into a middle-class Indian family. The parents, looking to secure their child's future, decide to make a small, one-time investment. Instead of a fixed deposit or a piece of gold, they choose something different. They take 10,000 rupees and buy shares in a company whose products are already a quiet part of their daily life. That company is Nestlé India. They buy the shares, get the physical share certificates, and then they do the hardest thing of all. They forget about them. They don't check the price every day. They don't panic during market crashes. They simply hold on, letting the power of time and business growth do its work for them. This single decision, made with foresight and patience, becomes the most powerful financial gift they could ever give. Fast forward to today, 2025. That child is now 31 years old, an adult navigating their own career and life. The small sum of 10,000 rupees, which seemed like a decent but not life-altering amount back then, has transformed into something truly extraordinary. It has grown into a staggering 7.5 crore rupees. This is not a lottery win. It is not the result of some risky speculative bet on a hot new tech startup. It is the outcome of backing a solid, dependable business that has woven itself into the fabric of Indian society. This story is a powerful testament to the idea that you don't need to be a market genius to build wealth. Sometimes, the most brilliant strategy is to buy a great company and simply let it grow over a lifetime, turning an ordinary investment into an extraordinary legacy. This journey from a few thousand rupees to several crores encapsulates the very essence of long-term value investing. It highlights a fundamental truth often lost in the noise of daily market fluctuations and the chase for quick profits. The real magic happens not in timing the market, but in time in the market. The parents in our story didn't have access to sophisticated financial models or insider information. What they had was common sense. They saw a company with trusted products, a strong presence in local kirana stores, and a brand that resonated with families like theirs. They bet on the simple idea that as India grew, so would the consumption of these everyday products, from baby food to instant coffee and noodles. Their patience paid off in ways they might have never imagined. Each market downturn, each period of economic uncertainty, was just a small bump on a long road leading upwards. While others panicked and sold, their inaction became their greatest strength. The investment quietly compounded year after year, decade after decade. The company grew its sales, expanded its product lines, increased its profits, and rewarded its shareholders. The story of this Nestlé investment is more than just a financial case study. It's a lesson in financial wisdom. It teaches us that wealth creation is often a marathon, not a sprint, and the most reliable path to financial freedom is paved with patience, discipline, and a belief in the enduring power of great businesses. Let's travel back in time to 1994. India was a country in the midst of a profound transformation. The landmark economic liberalization of 1991 had just begun to open the doors to the world, but its effects were still trickling down. Life for the average Indian family was modest and defined by careful spending. A scooter was a prized possession, a foreign holiday was a distant dream, and consumer choices were limited compared to the explosion of brands we see today. The stock market was not a common topic of dinner table conversation. It was seen as a complex and risky arena reserved for specialists, not for the everyday person saving for their family's future. The Sensex itself was hovering around the 4,000 mark, a tiny fraction of its value today. In this landscape, Nestlé India was a familiar, yet not entirely dominant presence. It was a company that operated quietly in the background of Indian life. Most households knew its name. Nescafé was the instant coffee of choice for many, a small luxury that brought a modern touch to the traditional tea-drinking nation. Cerelac was the go-to baby food, a brand that mothers trusted implicitly for their infants' nutrition. And then there was Maggi, the 2-minute noodles that were slowly but surely becoming a beloved snack for children and adults alike. These products were available in the smallest of towns, thanks to a distribution network that was already deep and wide, reaching into the corners of the country where many other new brands couldn't. The key to Nestlé's position was not aggressive marketing or flashy advertising. It was trust. This trust had been built over decades. The Swiss parentage gave it a halo of quality and reliability, which was a significant advantage in a market where consumers were wary of new, untested products. When a mother chose Cerelac, she was choosing a global standard of safety and nutrition. When a family bought a pack of Maggi noodles, they knew they were getting a consistent, tasty, and convenient meal solution. This deep-seated trust was Nestlé's moat, its invisible shield against competition. It wasn't just selling products, it was selling peace of mind to millions of Indian households. Even with this trust, investing in Nestlé in 1994 required foresight. It wasn't the most talked about stock. The darlings of the market were often in heavy industries or manufacturing sectors. To look at a consumer goods company selling coffee and noodles and see a multi-crore future was to bet on a fundamental shift in Indian society. It was a bet that as incomes rose, people would spend more on convenience, on trusted brands, and on small, affordable luxuries. It was a bet on the aspirations of the emerging Indian middle class. The genius of the 10,000 rupee investment was in recognizing this quiet underlying trend long before it became an obvious megatrend driving the Indian economy. Now let's break down the incredible mathematics behind this wealth creation journey. How did a simple 10,000 rupees blossom into a fortune of 7.5 crore? The answer lies in the powerful combination of share price appreciation, stock splits, and the sheer force of time. In 1994, the share price of Nestlé India was trading at approximately 210 rupees per share. So, an investment of 10,000 rupees would have fetched you around 47 shares of the company. At that time, this might have seemed like a small holding, a minor entry in a physical ledger. But this was the seed from which a mighty financial tree would grow. The key was that this seed was planted in fertile ground, a fundamentally strong company with immense growth potential. The first major catalyst for growth was the pure, unadulterated rise in the company's stock price. As Nestlé consistently grew its sales, profits, and market share, its value as a business increased. This was reflected in its stock price, which began a long, steady climb over the years. But the real accelerator of wealth was the magic of stock splits. Companies often split their shares to make them more affordable for retail investors, thereby increasing liquidity. For a long-term investor, a stock split is like a bonus. In 1996, Nestlé announced a stock split in the ratio of 1 to 10. This meant that for every one share you held, you were given 10. Suddenly, your holding of 47 shares multiplied to 470 shares without any additional investment from your side. The compounding journey didn't stop there. The investor simply held on to these 470 shares for the next 2.5 decades. The business continued to perform exceptionally well, navigating economic cycles and growing its brand portfolio. Then, in late 2023, with the share price having soared to incredible heights, Nestlé announced another stock split, again in the ratio of 1 to 10. This was a massive multiplier event for our patient investor. Their holding of 470 shares instantly transformed into a whopping 4,700 shares. This is a crucial point to understand. The number of shares owned had increased 100-fold, from 47 to 4,700, purely through corporate actions, not by investing a single extra rupee. This brings us to today, July 2025. After the recent split, the share price of Nestlé India is trading at around 16,000 rupees per share. Now we can do the final calculation. Take the total number of shares our investor holds, which is 4,700, and multiply it by the current market price of 16,000 rupees per share. The result is a staggering 7 crore, 52 lakh rupees, or approximately 7.5 crore. This is the beautiful, almost unbelievable outcome of long-term investing. It shows how a small initial capital, when invested in a high-quality business and left untouched, can compound its way to creating generational wealth. It wasn't about complex trading strategies, it was about simple arithmetic amplified by decades of patience. What fueled this incredible 30-year growth story for Nestlé India? It wasn't just luck or being in the right market at the right time. The success was built on a powerful and sustainable business model, the core of which was its portfolio of iconic brands. Think about it. Brands like Maggi, Nescafé, Kit Kat, and Cerelac are not just products on a supermarket shelf. They are a part of the Indian cultural vocabulary. Maggi, in particular, transcended being a mere snack to become an emotion. It's the go-to comfort food for students in hostels, the quick meal for busy professionals, and the creative base for countless street food vendors. This deep emotional connection creates a level of brand loyalty that is incredibly difficult for competitors to break. This powerful brand loyalty gives Nestlé something that every business dreams of: pricing power. Pricing power is the ability of a company to increase the prices of its products over time without significantly impacting customer demand. Because customers trust the brand and have an emotional connection to it, they are willing to pay a small premium for the quality and consistency they expect. When the cost of raw materials like wheat or coffee beans goes up, Nestlé can pass on a portion of that increase to the consumer. This protects its profit margins and ensures that the business remains healthy and profitable even during periods of high inflation. This is a characteristic that separates great companies from good ones. Furthermore, this pricing power directly translates into high and stable profit margins. Nestlé operates in the fast-moving consumer goods sector, which can be very competitive. However, by focusing on value-added products and building strong brands, it avoids competing solely on price. A local noodle brand might be cheaper than Maggi, but it doesn't have the same legacy of trust and taste. This allows Nestlé to command better margins than many of its peers. Consistently high margins mean the company generates a lot of cash, which it can then reinvest into building its brands further, expanding its distribution network, and innovating with new products, creating a virtuous cycle of growth. The final piece of this puzzle is the constant innovation and expansion of its product portfolio. Nestlé has never rested on its laurels. It has skillfully used the trust earned from its core brands to launch new products and enter new categories. From Nescafé Classic, it expanded to Nescafé Gold and a range of ready-to-drink cold coffees. Under the Maggi brand, it introduced a variety of masala mixes, sauces, and new noodle variants. This strategy of premiumization and diversification ensures that the company continues to grow. It caters to the evolving tastes of Indian consumers, encouraging them to upgrade and spend more, thereby continuously expanding its revenue streams and solidifying its market leadership. Beyond the phenomenal growth in its share price, there's another, often underestimated component to Nestlé's wealth creation story: dividends. Now, dividends are basically a portion of a company's profits that it distributes to its shareholders. For a long-term investor, dividends are a really powerful tool for compounding wealth. They're a tangible reward for your patience, a regular cash flow that you receive simply for holding on to your shares. Nestlé India has a long and consistent history of paying dividends. As a mature, profitable, and cash-rich company, it has consistently shared its success with its investors. For our investor who bought shares way back in 1994, these regular dividend payments would have started as a small trickle of cash. But as the years went by and the company's profits grew, so did the size of the dividend payouts. More importantly, after the stock splits, the number of shares our investor held increased dramatically. This meant that the total dividend amount they received also multiplied significantly. Think about it for a second. A dividend of 10 rupees per share on the initial 47 shares is just 470 rupees. But a dividend of 10 rupees per share on 4,700 shares is 47,000 rupees. This is the power of holding more shares. The dividend income stream, which was once negligible, would have grown into a substantial amount of passive income each year. This is a crucial aspect of investing in so-called boring but stable companies. Now, a smart investor has two choices with this dividend income. They can either use it as a source of regular income, or they can reinvest it back into buying more shares of the company. If our investor had chosen to reinvest the dividends, the compounding effect would have been even more explosive. This strategy, known as a dividend reinvestment plan or DRIP, creates a powerful snowball effect. The dividends buy more shares, those new shares then earn their own dividends, which in turn buy even more shares. Over a period of 30 years, this reinvestment strategy could have added several more crores to the final corpus, taking the total return to an even more astronomical level. The consistency of Nestlé's dividends also sends a powerful signal about the health and stability of the business. A company that can afford to pay and grow its dividend year after year is a company that is confident in its future earnings. It really demonstrates financial discipline and a management team that is focused on creating shareholder value. For our investor, this would have been a constant source of reassurance. Even during times of market panic, the arrival of the dividend check would have been a reminder that the underlying business was still strong and performing well. It's the ultimate proof that you are not just owning a stock ticker. You are a part owner of a thriving, cash-generating enterprise. No great story is without its challenges, and Nestlé India's journey had its most significant test in 2015. This was the year of the Maggi crisis, a moment that really shook the company to its core and threatened to destroy its most valuable asset, consumer trust. The Food Safety and Standards Authority of India, or SSAI, imposed a nationwide ban on Maggi noodles, alleging that some samples contained unsafe levels of lead and mislabeled flavor enhancers. The news just exploded across the country. It was a public relations nightmare. The brand that was synonymous with comfort and safety was now being portrayed as a health hazard. The media scrutiny was intense, and public sentiment turned sharply against the company. In the face of this unprecedented crisis, Nestlé's stock price plummeted. Investors panicked, and many rushed to sell their shares, fearing the worst. The financial impact was immediate and severe. The company had to recall and destroy over 30,000 tons of Maggi noodles from millions of stores across the country, a logistical and financial nightmare that cost them hundreds of crores. For a moment, it really seemed like the iconic brand might never recover. This was the ultimate test of resilience. For our long-term investor, this would have been a period of immense anxiety. Seeing a significant portion of their investment's value wiped out in a matter of weeks would have tested their resolve to the limit. However, Nestlé's response to the crisis is a masterclass in corporate governance and crisis management. Instead of being defensive, the company took a proactive and transparent approach. It consistently communicated with the public, maintained that its product was safe, and complied with all regulatory directives. It engaged in one of the largest recall operations in Indian history. Most importantly, it took its case to the courts and worked tirelessly to provide scientific evidence from accredited labs to prove the safety of its noodles. The company put its long-term reputation ahead of short-term financial pain, a decision that would prove to be incredibly wise. After a 5-month-long battle, the ban was eventually lifted as courts and laboratories cleared the product. Nestlé then executed a brilliant relaunch campaign with the tagline "We miss you too," tapping into the deep emotional connection customers had with the brand. The comeback was spectacular. When Maggi returned to the shelves, it just flew off them. Consumers welcomed their favorite noodles back with open arms. The crisis, in a strange way, ended up reinforcing the brand's strength. It demonstrated just how much people loved and missed the product. For the investor who held on through the turmoil, their patience was rewarded handsomely as the stock price not only recovered but went on to reach new all-time highs, proving the company's incredible resilience. Behind the glamour of iconic brands and dramatic comeback stories lies the unglamorous but essential foundation of operational excellence. A key reason for Nestlé's enduring success in a complex country like India is its world-class supply chain and distribution network. For decades, the company has invested in building a robust system that can get its products from the factory to the remotest villages in the country. This network is a massive competitive advantage. While a new competitor might be able to create a good product, replicating Nestlé's reach into millions of Kirana stores is a task that takes immense time, capital, and effort. This deep penetration ensures that wherever a consumer is, a Nestlé product is always within arm's reach. Another pillar of its operational strength is an uncompromising focus on quality and R&D. The Swiss quality perception is not just a marketing gimmick, it's actually backed by rigorous processes and standards. The company operates its own state-of-the-art R&D centers in India, which work on adapting global products to local tastes and developing new products specifically for the Indian palate. This focus on quality was a key reason why the company was able to scientifically defend itself during the Maggi crisis. Consumers' long-term trust is ultimately built on the consistent experience of a safe, reliable, and high-quality product, and Nestlé has made this a non-negotiable part of its business philosophy. Nestlé's growth strategy can be described as slow, steady, and cautious. In a world that often rewards aggressive, fast-paced expansion, Nestlé has always chosen a more measured path. It doesn't rush into launching dozens of new products every year. Instead, it carefully studies the market, identifies a genuine consumer need, and then invests heavily in building a brand in that category for the long term. This approach might seem boring to some, but it minimizes the risk of costly failures. This disciplined capital allocation ensures that the company's resources are used effectively to generate sustainable and profitable growth, rather than being wasted on chasing fleeting trends. This cautious approach also extends to its financial management. Nestlé India has consistently maintained a strong balance sheet with very little debt. It funds its growth primarily through its internal cash flows. This financial prudence makes the company incredibly resilient during economic downturns. When interest rates are high or credit is tight, companies with high debt levels struggle. Nestlé, on the other hand, can continue to invest in its business without being constrained by external financial pressures. This operational and financial discipline is the invisible engine that has powered its consistent performance for over 3 decades, providing a safe and stable foundation for long-term investors. The incredible story of the 10,000 rupee investment in Nestlé teaches us one of the most profound lessons in finance. True wealth is created through patience, not speculation. The investor who made a fortune did not trade frantically. They didn't try to predict the market's next move. They simply identified a great business and had the conviction to hold on to it through thick and thin for decades. This buy and hold strategy, often dismissed as too simple in today's fast-paced world, is still the most reliable path to financial independence for the average person. The biggest challenge is not picking the right stock, but having the emotional discipline to not sell it during periods of panic or euphoria. So, how can we spot the next Nestlé today? We need to look for companies that share the same fundamental characteristics. First, look for a strong and trusted brand with a deep emotional connection to its customers. This creates a moat that protects the business from competition. Second, look for a company with pricing power. Can it raise its prices without losing its customers? This is a sign of a dominant market position. Third, look for a business with a long runway for growth. Is it operating in a sector that is set to benefit from India's long-term economic growth and rising consumption? These are the foundational traits of a potential multi-bagger. It's also crucial to look for companies that are financially disciplined and have a history of consistent performance. Check for low debt levels, stable profit margins, and a consistent track record of generating positive cash flows. A history of paying and growing dividends is another excellent sign of a shareholder-friendly management and a healthy business. These are often boring companies. They might not make headlines every day like a hot tech startup, but they are the ones that quietly compound your wealth year after year. Think of companies in sectors like consumer staples, high-quality banking, or specialized chemicals that have strong defensible business models. Ultimately, the journey from 10,000 rupees to 7.5 crore is a testament to the power of investing in ordinary, everyday products. Nestlé's success was built on something as simple as a cup of coffee and a bowl of noodles. It proves that you don't need to understand complex technologies or bet on speculative ventures to build immense wealth. You can do it by investing in the things you see and use around you every day. The greatest opportunities often hide in plain sight, in the boring, dependable companies that form the backbone of our economy. The real secret is not a stock tip, but a change in mindset. Think like an owner, not a trader, and let the power of time work its magic.